what can be done to combat volatility. There are really three basic ways to protect from your retirement from market volatility. The first way is diversify and adjust your risk. The second one is strategic withdrawal timing. Well, and the third one is tax efficient strategies to protect wealth. Now, if you diversify and adjust your risk exposure, one of the things that people don't recognize is how much risk they have in a portfolio. There is a stock, I'm going to go back to NVIDIA again. NVIDIA has a risk number of 94. In the world of risk numbers, it means that relative to the market, there's a substantial amount of risk within the stock. The S&P 500 currently has a risk number of 77, so that gives you a little bit of starting point. NVIDIA has a 94 risk, which means it's going to be more volatile. But for that, it gave a much higher return. Well, Ford Motor Company also had a risk number of 94. And Ford Motor Company has not come even as close to NVIDIA as returning over the years, right? But they are both as volatile. So you've got to look at what kind of risk are you taking in your portfolios. One of the things I see all the time are you'll see funds, mutual funds or exchange traded funds that are more volatile than the S&P 500, but it may have an 89% risk, 89 risk score, and it's underperformed by 4 or 5% per year. Well, if you multiply 4 or 5% per year to what they could have gotten, you look at per 100,000, it's $5,000, right? So if you take that over 8 years of 5% lower than what it should have been, and you multiply that out, it's a substantial amount. The other thing is rebalancing. Rebalancing means that you take the stocks that have gone up and you push it down to the stocks that haven't done as well. And ideally, one may want to look at lower risk investments, right? It's very important to have lower risk investments, because if you don't have lower risk investments, if the market decides to move all over the place, then you can be caught off guard. Now, another way you can go about that is strategic withdrawal timing. This is one that is substantially overlooked. You can avoid withdrawing funds during downturns, which means that if the market goes down, you'd have to have a secondary source that you can pull income, which a lot of people don't. So it forces them to take money out of something that maybe gone down 10, 15, 20, or even 38%, as we saw, right? You can delay those withdrawals until you have a little bit more of a bounce back, but some people can't do that because they need that monthly income coming in, right? Or you can move your withdrawals to the year end. So let's take a look at the year end withdrawals and tell you a little bit about why it makes a big difference. Let's look at Sam and Lisa. Both are age 65. Sam has an IRA balance of $1 million, as does Lisa. They both decide that they're going to take money out per year. Now, Sam withdraws $60,000 in January each year and then earns 7% on the remaining balance. Lisa lets her portfolio grow at 7% all year and then withdraws $60,000 in December. So one is taking money at the beginning of the year, one is taking money at the end of the year. Well, what's the impact? Well, we can see that 10 years after doing this, you have a portfolio and Sam's balance is lower than Lisa's balance, right? But in year 20, look at the difference. It's almost a $200,000 difference, right? And if someone retires at, age 62, the 200,000 can go towards medical care. What if someone retired at age 62 and they're now in their 90s? It's almost a $400,000, almost a $400,000 difference in terms of legacy, right? Because at that point, it's not so much of the fact that you are going to take the money, because if you got sick, there's a higher probability of it being terminal. But look at the difference between just shifting the distributions by the end of the year. It can make a huge difference. And here's a graphic form of this, right? If Sam withdraws in January versus Lisa withdrawing in December, that's a huge, huge difference. So even the impact of when you take money out can make a big difference. So another way that you can do this is through tax efficient strategies. You can do Roth conversions, which I'm not going to go into today. You can do, but it's a way to have tax-free and tax-deferred monies for the future. which you pay taxes now, and you can go ahead and convert that out, and anyone can do a Roth conversion, but there is tax due for the tax year that you do the conversion. Bill Gates could convert a Roth if he wanted to, but you want to talk to your tax person about what the impact would be for you. There's tax loss harvesting. Tax loss harvesting is taking money in a non-qualified account. That's an account that you can buy and sell, and you can take advantage of long-term capital gains versus long-term capital losses. So you can take a account with a gain, offset it with a loss, still take income from it, but not pay any taxes on it. Or you can choose to delay Social Security, which is another way that you can delay or protect your retirement from market volatility, right? So what are the next steps? The next steps are you got to be proactive. In life, it's you don't know what you don't know. Little tiny tweaks like the ones I just talked about make a huge, huge difference. There are many tweaks that make a big difference. I'm going to give you an example. I have a friend of mine who I went to high school with, and I grew up really close to in Southern California, really close to where I work in Southern California. And his mother was a really successful realtor, and she had to stop working at the age of 62 because she lost her vision due to macular degeneration. So she had $1.8 million in a retirement account when she retired, in a SEP account to be exact. And she had her house that she had about $600,000 worth of equity in. Well, because she went blind, she had to have care. Well, the care costs a substantial amount because it's very hard to work when you can't see. So she had to stop working. Someone had to start coming in her home because that's what she chose. And during this period of time, she had to take out a huge chunk of money every year. So her care provider cost $10,000 a month, and she had to take out $180,000 per year just to offset. And that's not food, that's not anything else. Well, unfortunately, she was starting to run out of money, so she actually decided not to have a caregiver at night, and she fell down the stairs and she broke her hip because, well, she was blind, right? And what happened to her? Well, she had to go into skilled nursing, and skilled nursing was very expensive. End of a long story, she ended up plowing through $1.8 million in all the equity in her house, and she ended up in a Medi-Cal facility. She died last August at the age of 78 with $30,000 to her name. It's horrible. How could this have been averted? Had she planned, right? But she never thought that anything would actually happen to her. So you don't know what you don't know. Planning is paramount. You've got to be proactive, and you have to look at your portfolio and really understand how it works. In retirement, it's very important that you don't make any assumptions, that you don't think that empirically things will be the same, because things will change. People have things that are long-term issues, be it mobility issues that are very expensive to support, cognitive issues that are very expensive to support, macular issues or any kind of eye issues. If you can't see, it's expensive because there needs to be someone else to care for you. And a lot of people sometimes think, well, I'm married, so my spouse can do it. People generally age up together, so it's very difficult. I have an uncle who married a woman who was 20 years younger than him. Well, his wife passed away at the age of 68, 2 years ago. And he was 88 years old. She got early onset dementia. She got it when she was like 52 years old. And he ended up taking care of her. And it was substantially expensive. Matter of fact, all three kids were spending $3,000 a month to support her. And all of his pension, Social Security, everything he had was going towards his wife for 20 years. He has no more money. He lives with his son, fortunately, but he doesn't have a dime more. because he didn't think it would happen. And he thought his insurance plan was having a younger wife. So you just don't know. And it's really important that you vet out options. I mean, any situation that potentially could happen in life. Life is very unexpected. You can't tell what's going to happen, but I can tell you that you can plan for about 80 of it. 20% you can't get in front of, but the other 80 you can. Most people have it flipped. Most people plan for 20, and that's the 80% that ends up ultimately causing a bunch of issues. So those are the main things that I want to discuss today with market volatility. If you remember nothing else, just remember that you can affect change and you can make a huge difference with how the last 20, 30 years of your life goes, because it's really important that you recognize that you have to have a plan. So this is me. My name is Allie McFarland. I am a managing partner at Wealthfolio Advisors, and we've got offices in San Francisco, Sonoma, and a couple offices in Long Beach. Thank you for joining me today. You can reach out to me by phone on the number on your screen, or you can email me if you'd like to see me to ask any more questions or to set up a time to discuss this more.